Welcome to session 4 of RSM's 2020 Tax Summit Week. This session is Death and Taxes, updating your estate plans for new laws. At this time, I'm pleased to turn our call over to our first presenter, Rebecca Warren. Rebecca?
Thanks, Allison. So welcome, everyone, and thanks for joining us. I hope you've had a good day today. It's our first day of our Tax Summit. So in preparation for today's webcast, I actually kind of looked back and revisited. We were having a similar conversation last year, and uncertainty and not knowing what was going to happen. We had just had the election. So to some degree, things haven't changed too much other than we have some idea of what the proposals might be. But it's evolving week to week. The threats to the gift and estate tax regime that we currently have tend to wax and wane with time. And so today we're going to focus on, what is the latest, what has been going on, and we got new proposals last week, as most of you are aware, and how we can plan with flexibility in mind to kind of accommodate the uncertain future that we're looking at. So with me today, I'm Rebecca Warren, and we have Carol Worley and Michael Reeves, and they're my colleagues here in our National Tax Group. And so we're going to go through and move forward here. Kind of the House Ways and Means proposals, those came out about a month ago. And then last week we had the Rules Committee came out with kind of their version of things. And then we'll have a discussion about building flexibility into your current plans and some strategies to consider. Then we'll turn it over to Michael. He's going to cover some life insurance and trust planning for us. And then we'll wrap up with Carol, and she's going to talk about some valuation issues that have come up in the current proposals or the House Ways and Means proposals. Some retirement planning, and also we've added in a small section here on the billionaires tax because that came out after this presentation was put together, but we will discuss that. So I'm going to hand it over to Michael, and he's going to kick us off.
Thanks, Rebecca. So here we have a quote, right? In this world, nothing is certain except for death and taxes. And even in times of uncertainty, we know at some point tax will be paid, even with the most efficient estate plan in place. So as we go along today, let's consider your current plan and that of your clients. And through today's webcast, keep in mind any questions and write down any tips you may come through with this. So we do not know what future legislation will contain. As Rebecca mentioned, there's been many changes from recent proposals, but we do have, I'm going to call it a menu of items that may be included. Now, initially, when we were preparing for this, as Rebecca mentioned, we had the House Ways and Means Committee releasing their proposals, which we will see on the following slides, and I'll go through those here. And then last week, the billionaire's income tax was proposed by Senator Ron Wyden, and then, of course, a new framework for Build Back Better from the House Rules Committee. Keep in mind as we go through, right, there's no one plan. And I think that's important to take away, whether it be for your own plan or your clients. Obviously, we need to look at all the facts and circumstances surrounding it. Before we get started, we're going to start off with a polling question here. So which proposal listed below will have the most impact on you and or your business? Please select your response and hit submit. Now keep in mind that these are proposals from the Ways and Means Committee, and we'll keep this here let's use as a menu item. So even though this wasn't included in the most recent proposals last week, this is a really menu item of something that may be included in the future. And as people are coming through, if you think about it, as where we progress, the House Ways and Means Committee first had their proposals of September 14th. And, with this menu, I think it's important to consider that initially, the proposals have all geared towards high-income taxpayers, and trusts are really a part of a lot of those high-income taxpayers' plans. And some of the proposals that we didn't see that were somewhat surprising were, for example, reducing the estate exemption or hitting those grantor trusts, which we'll discuss on the next slide. So I'm going to move it forward here in a few seconds. All right. So it appears, and I think this is probably what I would think too, is A, we have the potential reduction in estate and gift tax exemption. And we'll go through all these in just a little bit more detail too in the next two slides. The potential estate inclusion of grantor trusts is about 70%. The next majority, we have the potential for retirement plan limitations and proposed changes, which is interesting, and Carol will go through some of that piece at the tail end. Then, of course, the potential for transactions between a deemed owner and a grantor trust. So with that in mind, first we're going to start on the trust and estate income tax side of things. This, of course, would include potential transactions with a grantor trust. And as you look at this slide, as I mentioned before, this is the Ways and Means proposal before updates and kind of the pared down version by the House Rules Committee and the new Build Back Better. Anything that has a line through it is something that was not included in the most recent proposals. But we kept it here because I think it's good to see what was removed and what could possibly come back into play. So on our proposed law changes on the left-hand side, what's still around is this surcharge. Right, under current law, there is nothing similar, but under the proposals, there will be a surcharge on 5% of modified adjusted gross income that exceeds $200,000 for estates and trusts. And then if that income level increases to over $500,000, there's an additional 3% surcharge. As I mentioned before, this kind of attack on trust, this would be one area where some revenue would be generated. And I think, unfortunately, the bad side is, for hitting estates at $200,000, those aren't vehicles that are typically set up right for planning purposes. These are things that come into life when someone unfortunately passes away. So we'll see what happens in this arena. But I do think this would impact quite a few estates, especially and certainly trusts. The second item we have is the long-term capital gains kind of rate increase, right? Now, we'll talk a little bit about the Green Book later, but in this Ways and Means proposal, the capital gains rate was increased to 25% versus the current qualified rate of 20%. This is no longer included in the most recent proposals. One of the, which I think is an interesting side, is the Section 1202 exclusion. So this is for qualified small business stock, which has many rules around it for the stock to qualify, which we won't get into. But one of the current benefits is that the gain on that stock, there's an exclusion allowed of up to 100% of the total gain, and it depends on the acquisition date. There's also other limits at 50 and 75%. What this proposal does is remove this 100% and the 75% exclusion amount and limits it to only 50%. And this is for all estates and trusts. So there used to be a planning opportunity using trusts where you could use multiple irrevocable trusts to take advantage of multiple exclusions. And this may not be as effective now if it's only a 50% exclusion. The ordinary rates, I believe the proposals here, we're kicking the rate back up to 39.6%. There was already a sunset to come into play after the Tax Cuts and Jobs Act after December 31st of 2025, where those would be reverting back. And as we know, one of the main items in these proposals has been whether or not there will be any rate increases. And as we move forward with our menu items, we will see there's a surtax, which is a percent on a certain amount of income, which apparently that may make it through at least on the current proposal. One of the big items here for net investment income tax. So net investment income tax, we have a 3.8% tax. It's on the lesser of your investment income or the excess of modified adjusted gross income above a threshold amount. Now, one thing under current law is if there's material participation rules and other rules that if you meet these items, the income is not subjected to the net investment income tax. Now, what the proposal is trying to do here is basically subject undistributed specified income as well as other active income to net investment income tax, which would be a big hit on trusts, specifically those where a trustee may materially participate or is active in, let's say, an S corporation or closely held business that the trust is involved with. Now, trusts and individuals obviously have different material participation rules, but keep that in mind. This is something that, once again, you have a 3.8% tax now possibly on trusts that you wouldn't have in the past. You may even have a 5% surcharge. And one of the other menu items here is a 39.6% rate, which isn't included, but if that does, we're quickly approaching a higher rate where we may need to rethink and do some more distribution planning. The last item here is a qualified business income deduction. This allows under current law a 20%, subject to limitations, a deduction and taxable income phase-outs for a certain qualified business income. Now this was under one of the proposals capped at $10,000. Now this was a friendly site not to see it included, and as we have it crossed through here, that's not included in the most recent proposal. So the next item, which you'll notice, there's really nothing remaining here from the most recent proposals, the estate and gift tax side. Now the majority of the individuals on the call mentioned, that the exemption decreasing was really something that would be the most impactful to them or their clients or business. And I agree. So one thing to keep in mind too here is the exemption amount from the Tax Cuts and Jobs Act increase. If a client or a taxpayer, let's just say a taxpayer has the full amount remaining and they only gift $3 million while it's at that excess or higher amount of rate, on the decrease, that $3 million will eat into the pre-Tax Cuts and Jobs Act amount. So really playing around here is get with your advisor to see if it makes sense to use that increase amount or if it makes sense to maybe wait. So under the current law, it's $11.7 million, which is set to sunset. And the proposal, the exemption was adjusted to an estimated amount of around $6 million. Valuation discounts, which we'll mention later on this webcast as well. Originally, under current law, right, we have discounts available for transfer tax purposes, for lack of marketability and lack of control, among of others. And the proposal, basically these valuation discounts for certain non-business assets held by an entity are going to be disallowed. So really affect what is going to be transferred and at what value, and may come into play as to what's held at death and what's given during life. I think the next two items are some of the more, I won't say controversial, but hard impacting in my opinion. For most common planning involves grantor trusts, and Rebecca will get into other planning and things to consider. But under current law, an irrevocable trust can be structured in that it's a grantor trust and that the trust assets are excludable from that deemed owner's estate. So under the proposal, the distributions and amounts in a grantor trust at death that were not previously subject to transfer tax would be included. Now, there are other rules around that. For example, if you have contributions in or distributions of in-kind distributions out, which is under a previous proposal, may have an income tax treatment. And that leads into our next piece here is under this typical irrevocable defective grantor trust strategy, there is sometimes a sale involved. And under current law, these sales are deemed to be between the grantor trust and the grantor and are disregarded for income tax purposes. But under the proposal, sales and other transfers, they would be regarded and you would have an income tax possible recognition event, which, we looked at our previous rates, would then also be at higher rates than they would be before. There may be a surtax, net investment income tax, but so keep that in mind from the individual side. Next, I'll turn it over to Rebecca for our next polling question.
Thanks, Michael. So what action are you likely to take regarding transfer tax planning? I might use the rest of my exemption before the end of the year. I need to examine my current plan, or I will wait until final proposals. Okay, so go ahead and answer that and hit submit. And kind of while you're doing that, I wanted to mention the Green Book because we're not going to really cover that in this presentation. But if you remember, several months ago, we had the Green Book come out and it gave us some proposals that we thought might come out of, or suggestions really, from the White House on what they wanted to see in the tax proposals. And one of those was gain recognition on death. And that has not come up in the House Ways and Means proposal or, the Rules Committee modifications to the proposal. So, right now that really hasn't been on the radar, that gain recognition. Could it come back? Yeah, anything can happen, but we haven't seen it. The other thing is the ordinary capital gains rate. Right now it looks like that won't happen because Senator Sinema came out and said, I don't want any rate changes. Well, taking the capital gains rate to the ordinary income tax rates would be a pretty dramatic change. So, I would think highly unlikely to see that. But did you have anything, Michael, that, stood out in the Green Book that you could think of that we aren't seeing right now?
Yeah, what's interesting when you think of, one thing is the in-kind transfers into and distributions from non-corporate entities would be subject to taxation. And I think that's something if, especially, let's say, grants or other trusts use in-kind distributions to pay that annuity or, something on a note, if that's actually a taxable transaction now, it really throws a hole in a kink in our current planning. And what do you do? Even thinking about an increased ordinary rate on capital gains or qualified income from the Green Book, and if there's some other, surtax or something else that goes into play, trusts really will have a hard time, I think, being maybe a vehicle for income tax planning outside of the legal and other reasons why we set up trusts.
Yeah, and combined with the changes in the grantor trust rules that were proposed, which I'm going to talk about here in a minute. Every step of the way, it seems like you're incurring some sort of tax, whereas today that's not the case. So I'll push forward now, and it's a little bit across the board. I'm actually surprised that there weren't more in the A category using the exemption, because we're seeing a lot of that. But really evaluating where your plan is today, that's important regardless of if you're near that 11 million, if you're above it or below it. Just reevaluating how all this is going to impact your plan. And then waiting. The only thing we caution with waiting is a lot of these proposals have dates that are either enactment or were actually prior to enactment, were introduction, which was, I believe, September 13th. So it may be too late for those of you waiting for final proposals. So stepping forward here, we're going to talk about grantor trusts a little bit. Now, as Michael pointed out, in the original proposal, there was a huge attack on grantor trusts, and those were stricken from the latest version. Something is probably going to come back. We don't know what it will be. We don't know if it'll be an adjustment to the lifetime exclusion amount, the 11.7, or if it will be some other factor like grantor trusts. So what do we do with our grantor trusts? Generally speaking, we've kind of laid out the flow of how assets, travel. They go from the settlor, the person who creates the trust, to the trust. And in this case, we've got all these different grantor trust tools listed here. And really the outcome we're looking for is to maximize what the beneficiaries will receive. So looking at our grantor trust, the grantor retained annuity trust, this is a trust that we see a lot with individuals who have probably almost or nearly exhausted their lifetime exclusion, because it uses little to no lifetime exclusion to make these transfers. The grantor retains an annuity, which is how it's, the gift value of it is discounted. And it's just the amount after the annuity period, the term of years, that passes to the beneficiaries of that particular trust. And that's really the gift component of it. If your assets in that trust appreciate, then you're going to get more at the back end of it that will transfer to your heirs. So what can we do with these if we've got an attack on grantor trusts? What we're seeing is a lot of people just holding off, not creating new grats right now, and just waiting to see what's going to happen. Now, if you've already got a grat in place, what can you do? You can do a swap if you've got assets. So a swap would be taking assets of equal value, fair market value, and swapping it with whatever asset is inside the grantor retained annuity trust to provide it with some liquidity in order to make the distributions. Because if you've got in-kind distributions, that was one of those things where you might have a gain recognition event and you want to avoid that. The intentionally defective grantor trust is probably one of the most popular tools we see, because like Michael mentioned, you can make a sale to that defective grantor trust and it's not recognized for income tax purposes. You don't need to pay a capital gain on that. There's no interest recognition on the note. So we see these a lot. You just make a seed money gift to it so that you can make that sale transaction. But what are you going to do if grantor trusts and transactions with grantor trusts are now recognized events? You probably want to, if you've got an outstanding note, you probably want to get that paid off if possible. So, create some sort of liquidity in there so that you can pay the note back to the grantor and settle it up. You also have the option, if the note's already paid, to do a swap transaction if there's an asset in there that is better off in your estate than in the trust. And there's different reasons for that, but it might be a low basis asset and you want it back so that when you pass, you get a step up in basis on that asset. So you may want to do a swap transaction with that trust. You can also turn off the grantor trust powers if the grantor trust powers are an issue and you want to continue to make gifts to that trust or things like that. And they typically have similar clauses that they use. The swap power is one of them. And you may be able to renounce those powers and make it a non-grantor trust. I'm not going to talk too much about the qualified personal residence trust because honestly, we haven't seen too many of them in the last decade. They are most effective when rates are high and rates have been low. But it's a trust where you can put your residence in there. Again, you retain an annuity, so to speak, because you have retain an interest, really, I should say, because you can live in the residence during the period in which it's, in that term of years. At the end of the term of years, you have to pay rent. So, we aren't seeing those too often, so I'm not going to spend a lot of time there. The one that we are seeing a lot right now is the Spousal Lifetime Access Trust. So this is a trust that you set up for your spouse, and your spouse is a beneficiary, typically along with your children. And so you can set that trust up, and your spouse can be the beneficiary. It's kind of a safety net, to say, because if something happens and you need access to that cash, or not you, your spouse, I should say, needs access to that cash, your spouse can access those funds. And so we're seeing a lot of that for people who are a little less secure about making the gift outright to their children, whether outright or in trust. And they want their spouse to have access to those funds. You can make those non-grantor. It's a little tricky, but we are seeing it done for other tax planning reasons. So it is a possibility. And then the irrevocable life insurance trust, again, another very, very popular tool that we see because you can purchase a life insurance policy or gift a life insurance policy into a trust. And the proceeds of that policy are outside of your estate. So you can have your taxable estate of, say, $50 million. You can have a $10 million policy in the trust, and that $10 million is not included in your taxable estate. So you don't need to include it. These are a little more difficult to create as non-grantor trusts because one of the provisions is in the grantor trust rules is paying premiums out of income. So you can't pay your premiums out of income, and it makes it a little more difficult to create a non-grantor trust. If you have one already in place, it's going to be really difficult to get out of it. So bottom line is these are the ones that we kind of need to look at and evaluate, what can we do? Are we comfortable with the place we're in? And, maybe there's things that we can change or asset swapping that we can do that make these tools a little more effective today, and maybe protect us in the future from these potential changes that are coming down the road. And again, bottom line is we want to maximize what our beneficiaries will receive, and that's usually by reducing your taxes. So I will move on, and we'll talk a little bit about flexibility. So we went over the grantor trusts. Now, what are some things that you can do to create flexibility in your plan as you have it today, or your potential plan that you're going to create in the near future? Fully utilizing the exemption if it fits. We don't want people to put all their assets or gift all their assets. You need something to live on in the future. So really gifting what you can to the extent that you feel comfortable. And that's the key. Evaluating trustee. So if you've got a grantor trust, typically you look to the grantor to figure out how the trust is taxable for state income tax purposes. But if you've got a trust that you're going to flip into a non-grantor trust because of some negative consequences that may occur because it is a grantor trust, you should take a look at your trustee and make sure you're picking the right trustee, because some states look to the trustee to determine whether the trust is going to be taxable in that state. So you can avoid tax, and say California is one of those that looks to the trustee. You can stay out of California if you pick a trustee in a state that is either doesn't have a state income tax, or doesn't look to the trustee to determine whether a trust is a resident trust. Distribution planning is going to be important if we see this surtax. So if we see this 5% surtax with an additional 3% bump at, starting at $200,000, you can make a distribution. For some of these non-grantor trusts, we can play with the amount of taxable income that we have based on making distributions. So you may be able to push some of that income out to the beneficiaries and play with the rates there.
Yeah, and Rebecca, one thing too on evaluating trustee to consider is this goes into play on material participation. So of course, if proposals come through and change net investment income tax, you can at least still have some non-passive income and losses. If the trustee meets any of the material participation rules, then the trust would deem to material participate in that activity.
Yeah, it's gonna change the dynamic, and I don't know if I mentioned, but there's this thing called a 65-day rule, and so you can make distributions up to 65 days after the close of the taxable year for the trust, and have it be retroactively considered part of that prior taxable year. So, you can come up to December 31st and realize, oh, wait a minute, I want to make a distribution because we're going to have a more favorable tax outcome if the beneficiary is paying the tax on those assets. So, you may see, or it may be beneficial to make that distribution in those 65 days and make that election in order to treat those distributions as if they were made in the prior taxable year. Trust would allow access
to Michael's comment about the trustee. We still don't have regulations that even tell us with certainty how a trust can be active. So if we have some of these changes enacted, it may not matter anymore. It could matter for passive losses, but anyway, it just further complicates the planning for trusts and the net investment income tax and passive loss rules.
Yeah. So trusts that allow access to funds. This goes back to that spousal lifetime access trust. We're seeing a lot of action in there and people creating trusts for spouses. This gives you the flexibility for your spouse to have access to those funds. But it uses your exemption, and ideally your spouse won't take distributions from that trust, and those assets will pass to whoever the beneficiary is, presumably your heirs. There's another option, the incomplete non-grantor trust. So this is where the grantor actually is a beneficiary of the trust. So, not only can your spouse access if you make them a beneficiary of the trust, but you can also access the funds. Now it's restricted in that you have a distribution committee that controls your access to the funds, but presumably if you request a distribution from the distribution committee, you've got friendly bodies on that committee and they will grant that distribution. Not a complete gift, so it's not going to use your $11.7 million, but you will retain the access, potentially you can retain access to the funds. Disclaimer, rescission, and marital planning. These are a little more complicated topics, but you can, your attorney can draft documents such that you can use a disclaimer, which is transferring assets from one trust to another. Usually it's done because there's changes to the document that you want to make. Rescission, so undoing the plan, or marital deduction. So you can there is an unlimited marital exclusion for gifts to U.S. persons. So if you want to not use your exclusion and make an election, you can put assets in a trust, and then in the subsequent taxable year, because the election is due on that following year's income tax return, you can make what we call a Q-tip election, and the assets will qualify for the marital deduction if the trust is drafted and has the appropriate terms to allow it to qualify for that. So that'll give you the flexibility of, okay, you want to put money into this trust, but you're not sure if you want to use your exclusion today. So you can, put in whatever you want. And then next year when you're filing the income tax return, you say, nope, I want to make that Q-tip election. I want this to qualify for the marital deduction. And therefore, it may fall under a different set of rules within the trust document, but the provisions are there and it's set up to allow the option to make that particular election. So those are a little more complicated tools that we can use, but they are being floated around in order to really provide some flexibility in, in options. Really, it's options, because you can create your standard non-grantor or grantor trust, but you can have some options if things change to then modify the plan itself. And then reviewing the current estate plan. This was one of the popular answers. You don't want any surprises. Nobody wants surprises, especially when you're talking about paying taxes. So really revisiting those plans today. Attorneys are going to be busy. Valuation firms are going to be really busy in the coming months. So take a look at that today and get it on the calendar. Look at your plan and make sure that everything you're comfortable with everything that you've got in place. So I'm going to pass it back to Mike, and he's going to go over our next couple topics.
Thanks, Rebecca. Before we get started, back to that last point is, what are you comfortable with in your plan? I had a client come and ask me, really, that is, what should I do? And in their current plan, they didn't have much room for estate planning because they needed the liquidity of most everything they had. They didn't have a large enough estate where they felt comfortable giving up even $6 million or using much of their exemption. So it's really looking through, where you're at today, what could happen, is there any planning that you're going to do regardless? Does that change now because of these proposals? Yeah, it's up to you. There's no one set plan. So we'll move along to life insurance and trust planning.
Michael, just another comment. I agree with you completely. I mean, I've had some discussions where we thought that the exemption was going to sunset and there was this focus on, I've got to use my exemption. But you need to first think about yourself and your ability to live off of your existing assets and consider the restrictions from these irrevocable type gifts. So I completely agree with your observation.
Thanks, Carol. All right, so for life insurance, and we'll spend some time here. We've got two columns. One item is kind of a hot topic I think most have seen or heard about, and the other item is our common planning. So a common structure in today's state for current estate plans is to use a trust to hold a life insurance policy. Now, this trust can be structured as such that for federal income tax purposes, it's taxed to the deemed owner or grantor trust, and they'll pick up obviously any of that income, while the trust can be irrevocable and be excluded from their estate. One of the menu items that we've discussed in the past, so one of these proposals, is the possible estate inclusion of grantor trusts in the deemed recognition events on transactions between a grantor trust and the deemed owner. So in this case, we'll think about an irrevocable trust that holds life insurance. The current structure, I'm the grantor and I make gift or put cash funds into this trust each year to allow the trust then to have funds to pay premiums each year. Under proposals, there now may be some estate inclusion, past the effective date, whatever that may end up being, if it even comes to fruition, then now I have some estate inclusion possibly. Maybe if there was a sale or some other structure to get this policy into the trust, I may also have some gain recognition. So the House Ways and Means Committee, proposals may cause a portion, right, we're not sure of the ILET to be included in the estate of the deemed owner. So what can be done, if these proposals are included in the final bill? One thing, and as Rebecca mentioned, this may be hard to do, is consider avoiding the grantor trust rules and ensuring that the trust is a non-grantor trust. Now, obviously, this may not make sense, but that's one way to avoid at least the estate inclusion. And of course, there's pros and cons, right, of doing this. This minimizes and hopefully completely avoids estate inclusion issues. And as we move down, consider pre-funding premiums in 2021. So one thing that can be done, which kind of interplays also with the exemption, is, what if we can pre-fund this trust now? How does it look from a liquidity standpoint, which now allows the trust in the future, if these proposals are enacted, to pay for its own premiums without the deemed owner or the grantor now having estate inclusion because they're putting contributions into this trust. The third item we have, what about loans? So maybe a more flexible situation and one that might be more advantageous for the grantor is, what about a loan to fund those future premiums versus just giving up those funds right now to pre-fund it? Of course, this is something we'll have to think about and consider, what that loan would mean. And then lastly, use exemption by funding an ILET. This could be to pre-fund premiums. This could also be to get the ILET going, get it set up. But right now, the exemption, and one thing is certain, is it's the highest it's ever been and may ever will be, right? If obviously inflation can adjust it in years going, if it doesn't go down this upcoming year, but it's going to sunset. And we have a date for that. And that seems to be an easy way to generate revenue and just allowing the sunset to happen versus passing any new legislation on this. The next column, which has been becoming more and more popular, especially with the proposals that really have to do with, if there are going to be income tax changes and even, wealth transfer changes and how we're going to do our plans, is there a way to use a life insurance product to basically negate some of the new legislation? One of these vehicles is called a private placement life insurance product, or PPLI for short, which is what we'll refer to it as. So this product, it's a type of variable universal life insurance, but with certain requirements and certain assets that are only available to this product. We won't get into the details of the rules, but keep in mind, if you are considering this, it has to be structured in a way to meet something called a 7-pay test, which avoids the policy being a modified endowment contract. One of the benefits of this PPLI is the cash withdrawals will be tax-free as long as you meet these certain tests up to the cost basis in the policy. So this allows for liquidity, or alternatively allows for continued growth in the policy to use as a wealth transfer, because just as other life insurance products, the death benefit typically should pass tax-free as long as you don't get into any issues with transfer for value rules. A few things to keep in mind. The investor must be an accredited investor and generally have around $5 million of liquidity to fund the policy. One thing that I've seen and been asked is, well, can we fund this with in-kind property, right? If I already have assets, can we do in-kind funding of this life insurance policy? That is risky, and the general answer is really no, to avoid the investor control rules and the diversification rules that need to be in place for this policy. That's not something that most of the large and well-respected companies will do, but it's around $5 million of cash. And what this allows for is this product, unlike the kind of on-the-shelf variable universal life products, allows investments in alternative investments such as funds, hedge funds, for example, that the typical investor would not be able to get into. Now, usually, especially if there's rate increases and an individual holds, let's say the hedge fund, directly, it's one of their own investments, it'd be taxed individually to them, right? They now have a surtax. It's going to be subject to net investment income tax. They may be taxed at the highest ordinary rate. We're looking well over 40% of tax, where if this is held in a life insurance product, there is no current tax. So that's a tax efficient way of holding this tax inefficient vehicle. You hold it in this insurance policy, and it allows for continued growth and a death benefit that will eventually pass to your heirs. keep in mind the rules are complex, and there are consultants out there that are more risky than others. So work with your providers. Definitely reach out to your tax individual and your other financial planners to go over these rules in more depth. But this is something that's hot, and I think will continue being something as a hot topic for those with significant wealth that can invest in them. And I will mention this, we will talk about the billionaire's tax, but this was something that was hit in the billionaire's income tax plan, basically getting rid of these tax benefits. And if you withdraw something, there would be tax currently, as well as an excise tax. I believe it was 10%. So after that, I will now pass it. Excuse me, we'll go to our polling question first. Do you feel that you have time to implement any changes in your current plan before year end? Now, this is interesting, and it leads really directly into what Carol will be talking about. And I think there's many planners now who would say they may be hard pressed to get valuations done, to get the documents drafted, to go through all the meetings with your income tax professionals, your financial planners and attorneys to implement something. It's a few more seconds here. We got answers rolling.
It's interesting because, in the previous proposal, we had this sunsetting occur of the exemption, and now it's out. So query, will it come back in again? And that's right. So is there time pressure or not? So we're in a very uncertain environment.
Yep, that is very true. I imagine, next week maybe we'll see something, and I guess we don't know. We'll find out. All right, we've got about 86% in. Wait another few seconds. All right, I'm moving along here. I mean, it's close. I think, well, the majority says no, but we're right on that line there with the yes. And to this point is if you can get some planning done, whether it be get the documents drafted, get something ready for turnkey, but you're just not quite turning the key yet, so to speak, and have it in place. Some of these rules, I mean, we didn't mention, but there are, if you have a contractual binding agreement in place already, you may be fine, for example, on the 1202 and some of the other items. But I'll pass it now to Carol.
Thank you, Michael. Well, as we've been saying throughout our presentation, this is really a start. We've seen different proposals. We've got 3 different proposals we've seen, and Michael referenced the Green Book earlier. So this is a start and not the end. The Senate has not yet weighed in, and senators have made it very clear that they're going to weigh in, so stay tuned. So we have existing case law and authorities in the valuation area that provide for discounts for owners of entity interests due to lack of marketability and lack of control. So that's the state of the law today. Valuation discounts were proposed in the original House version, which would have ignored these long-standing valuation principles. And those changes were proposed to be effective the date of enactment. But they are now out of this particular recent proposal as of last week. But that doesn't mean that these provisions would not return. The proposals provided that there would be no valuation discounts for non-business assets. So think of a partnership that owns only marketable securities held for investment. There would be no valuation discounts, as opposed to an entity that holds business assets, for which there would be valuation discounts under the previous proposal. Trader business was defined very narrowly for the real estate business, so the prior proposals, again, which were out, would have a major impact on real estate businesses or investments. For example, the owner of the entity interest in a real estate business would have to have met the rules for a qualified real estate professional having more than 750 hours of participation and spending more than 50% of their time in the real estate trader business. So that was a very strict rule, so that real estate businesses holding assets that don't give rise to that definition of trader business would not have qualified under the prior proposal for valuation discounts. And so that could really cause a mismatch between, for example, what may be in a buy-sell agreement for a real estate partnership, which would provide for a discount on a buy-sell, but that discount would not be allowed, for example, for estate tax purposes. So you could see a situation where you had one value for buy-seller agreement at death, for example, and another for what the fair market value is, again, creating a mismatch and possibly an argument that there was some gifting going on to the extent that we had different valuation rules applied for buy-sell agreements versus reflecting the true fair market value, and these artificially imposed proposals, which wouldn't really be fair market value, but would be for tax purposes only. So there was a real mismatch. And, again, as we've mentioned throughout the presentation, I keep hearing the word menu. And I think it made me think about a restaurant menu. You go into the restaurant one day and you choose from the menu. And then you go back another day and you choose different items from the menu. And then maybe a third day, you choose different items. So we're really in a menu environment where things are very uncertain, where things are going to keep changing and nothing is certain. So it's a crazy environment, but it's the environment that we're in now. So what if we don't have legislative changes related to valuation discounts? Well, don't think then if you see a final provision in a final enacted bill that doesn't have these provisions, because the IRS had previously proposed regulations that had a very similar effect in terms of disallowing discounts on non-business assets. They had proposed regulations prior to 2018 that would have caused that effect. In fact, there was a hearing in Washington, D.C. that I attended and spoke at where there were about 45 of us basically indicating that the proposed regulations did not reflect economic reality. And I think there were thousands of comment letters. That proposed regulation got pulled, but I could see it coming back if, we don't see it in legislation. Okay, this is our next polling question. Will the change in what discounts are available for certain assets affect your gifting strategy? So you've got two choices here. You've got yes and you've got no. In fact, even if we don't see proposed regulations quickly or legislation with respect to valuation discounts, IRS audits have been focused on valuation discounts for some time, for many, many decades. So a gift tax return that reflects a gift of an asset with discounting, or an estate tax return that reflects discounting, has been a subject of controversy with respect to IRS. And the IRS in their audits are focused on that. And typically you'll lose some of the discount when you are negotiating with the IRS. There's a box, for example, on a gift tax return that says, did you take a discount? And if you did, you check the box. Well, that's just a red flag for the IRS that says, please come audit me because I took a valuation discount. So no matter what happens, this is still going to be an area that's going to be under the microscope. Let's see, we've got about 83%. So pick your answer, yes or no, and I'm going to close the poll in 5, 4, 3, 2, 1. Oh, it's pretty even here. Very, very even. Retirement plan proposals. Well, look at this slide. This looks like some of the earlier slides with the lines through. And the lines through shade, these were the proposals previously by the House, the previous markup in September. These are all gone now, but are they really gone? So I'll talk a little bit about what some of those proposals were in the prior markup, but you can see a lot of these were just completely eliminated. These changes which were proposed to be effective after 12/31/21 and would have impacted retirement plans, IRAs, defined contribution plans, most commonly think of 401k plans. And again, they're no longer in the proposal, but they're still on the menu. And so we could see them come back at any time. So what were some of the highlights of those proposals? Well, for high income taxpayers, generally defined as $450,000 of income or more from married filing joint, there were proposals to require certain minimum distributions from IRAs and 401k type retirement plans where the retirement plan exceeded $10 million. And so that was definitely a proposal aimed at trying to prevent this accumulation in the mega IRAs. And I think that there was some attention, media attention to some of these mega IRAs that I think prompted these proposals. So what are some of the planning ideas that we should think about in the event that these proposals come back? One of the big items of focus, in addition to the were Roth conversions, as well as owning certain trade or business assets inside of one's IRA. So currently, under existing law, an IRA can hold non-publicly traded investments in assets. For example, a startup company. An IRA could invest in your startup company. An IRA could invest in this company even though you own 10% or more, even though you're an officer or director. The IRA can currently, your IRA can currently own those business assets and can currently also own interest in business investments, non-marketable, where you are required in order to invest in that particular company to meet certain minimum levels of income or specified education level or other credentials in order to invest. Well, the House proposal provided that an IRA could no longer hold those types of assets, along with some other rules related to prohibited transactions. Those proposals are gone now, but they were of significant concern with respect to IRA owners that had these types of business investments. For example, how easy would it be if you have your own business or your percentage ownership in an IRA to cure that, to get rid of that issue if this were to become law, for example? There was a 2-year grace period in the proposals, but it's very difficult to exit these investments within 2 years. Think about a hedge fund, for example, that met the proposals and would be required to be disposed of. And it's not so simple in that an IRA owner couldn't just buy the asset out of their IRA to solve the problem. So it's a good thing that those provisions are eliminated because they were very difficult. Now, we still have a remnant of that provision in the current House proposals, but it only applies to prohibiting IRAs to own interests in domestic, international sales corporations and foreign sales corporations. Don't ask me how those items got singled out, but I think that probably would be pretty rare. But if you have that situation, then under the current proposals, if enacted, it would disqualify the IRA and cause it to no longer be taxed as an IRA. There were also some focuses, there also was a focus on Roth conversions in the prior proposals, again, which are gone, but those would have limited Roth conversions for certain conversions of traditional IRAs, for example, that had after-tax contributions. There, the Roth conversion would have only been available for this calendar year, whereas other Roth conversions were limited to the next 10 years. So there definitely was a focus on limiting Roth conversions, again, due to some of the attention in the media with respect to mega Roth IRAs. There is an opportunity, if you do want to consider a Roth conversion, there is an opportunity this year to obtain a 100% charitable contribution deduction that could offset Roth conversion income. So, for example, a cash distribution or contribution to a charity, a public charity, that's not a donor advised fund or private non-operating foundation would be eligible for a 100% charitable deduction. Got to be in cash, got to be a qualified charity, got to be this year because that provision sunsets at the end of this year. It was part of the CARES Act, not part of any of this proposed legislation. But if you want a significant charitable deduction, this would be a year to consider a Roth conversion and a charitable deduction to offset. With respect to the surcharge that was discussed earlier, there isn't currently a charitable deduction allowed to reduce the surcharge tax. So this may be a last opportunity if the surcharge is enacted to be able to take a charitable contribution deduction and offset against Roth conversion income and get a full charitable deduction. Well, the final item I'm going to mention is the billionaire tax. And this provision was generally viewed as probably being dead on arrival. in that it is very complex. And I think the surtax that we talked about earlier replaces this. And it applies to applicable taxpayers, which is a defined term of art. And it was proposed last week, but again, it doesn't seem to be getting a warm reception. It would have been effective after 12/31/21. This proposal would require taxpayers that are applicable taxpayers to mark-to-market marketable securities each year, so liquid assets or relatively easy to value assets, and pay a tax each year, have a capital gain or loss each year. It would not, however, have required an annual mark-to-market on non-tradable assets or illiquid assets, hard to value assets, but rather would impose an interest charge. So you can see the complexity in this. And it also had a myriad of other proposed changes. Now, who would be an applicable taxpayer? Well, an applicable taxpayer would have either income or asset thresholds that exceed the limits. For joint and single filers, the income threshold would be adjusted gross income of greater than $100 million or assets of $1 billion, hence the name billionaire tax. Income from a grantor trust would be includable in this calculation. But for non-grantor trusts, the income threshold is quite a bit lower. The income threshold there for non-grantor trusts would be at least $10 million of income before an income distribution deduction or $100 million in assets. Now, distribution deduction is something that Rebecca spoke about earlier, where you get a distribution for deduction for distributions to beneficiaries. But the surtax would be viewed before that. It would also be applicable to taxpayers apply where there's certain gifts, bequests, and transfers in trust. And some of these things are very reminiscent of the original House proposal in that there would be trigger events with respect to transfers, for example, of a non-tradable asset to a grantor trust. That would trigger the gain. There would be a trigger event for actual and deemed distributions with respect to grantor trusts, such as death, such as termination of grantor trust status. So you'll see some of the same, similar types of proposals that were in the original House proposal, but now would only apply to this billionaire tax. There's also a proposal that echoes what was in the Green Book, which was to prevent the indefinite deferral of gains in a dynasty trust. I think that may have also been in some earlier proposed legislation too. So these thresholds really target a much broader group of taxpayers that other than billionaires. So the title is a bit misleading. The proposal also limits certain non-recognition and deferral opportunities for these particular taxpayers that would otherwise be considered, such as like-kind exchanges, deferred compensation, and Michael mentioned earlier the use of private placement insurance. So there would be an impact on being able to utilize those strategies under this proposal after December 31st of 21. And the proposal would also provide limits on allowing taxpayers to exclude the gain from the sale of certain small business stock. And it would also modify the qualified opportunity zone provisions. And those would be effective October 27th of 21. So significant proposals with respect to this particular billionaire tax proposal. And now I will switch to the last polling question and we will end our session. Would you like to talk more about this topic with an RSM professional? So as you're answering that question, I'd like to thank you for your attendance this afternoon. We really appreciate it. And please feel free to stay and chat with us in the networking lounge. And now I'm going to turn it over to Allison.
Thank you so much, Carol. Thank you also to Rebecca and Michael for the presentation today. And thank you so much to our audience for joining us. That does conclude day one of RSM's 2021 Tax Summit. But we do invite you, as Carol mentioned, to return to the networking lounge and chat with these presenters following the presentation. We also invite you to visit the resources list to the right of your screen where you can access a number of valuable resources available to you. You can find a number of other resources also in the Tax Resources Library within the RSM Tax Summit virtual environment. If you have met all CPE criteria for today, you may download a copy of your certificate by visiting the Certification Center and click the download icon. Be sure to access your certificate in the next few minutes before we conclude our event. Smartphone users can download their certificate from any computer at a later date using today's webcast link. Thank you so much for joining us today. We look forward to you participating tomorrow in day 2 of RSM's Tax Summit. Have a great day.